We can get started. So good afternoon, everyone. Welcome to the Global Virtual Seminar Series on Fintech, organized by the Center for Financial Markets and Policy at Georgetown. Before we get started, let me thank the other members of the team at the center, Rina Agarwal, John Jacobs, and Anna Kormis. And let me take a moment to thank also Ripple and their University Blockchain Research Initiative for their sponsorship. Today, we are delighted to have Tarun Ramadorai as our speaker. Tarun is a professor of financial economics at Imperial College London. He contributed massively in the areas of household finance, asset pricing, international finance, and real estate. And he's also greatly interested in finance and economic issues in emerging markets, with particular focus on India. Today, he will be presenting Predictably Unequal, the effects of machine learning on credit markets, co-authored with Andreas Fuster, Paul Goldsmith-Pinkham, and Ansgar Walther. Please feel free to ask questions at any time during the talk by either raising your hand or by posting questions through the chat. I'll be on this side, I will be handling all the questions for Tarun. Whenever questions show up, I'll just stop Tarun and unmute whoever wants to ask the question. And without further ado, let me pass the word to Tarun.
Thanks, Alberto, and thanks to all of you for inviting me to give this talk. So this is joint work, as you mentioned, with Andreas, Paul, and Ansgar. So what's the paper about? So, of course, you know, the FinTech audience is very familiar with questions of technology, and we know, I guess, many of you know, that machine learning has been rapidly adopted in many industries, and finance, of course, is one of them. A pretty important central application of machine learning in financial markets is for the analysis of default or default prediction in credit markets. So there have been a series of papers both in the CS literature as well as in the finance literature that talk about techniques to be able to do this. And in this paper, we take a slightly different question, which has also been very much of public importance, which is, what are the distributional effects of new technologies that come in? And in particular, what we have in mind can probably be easily kind of captured by this contrast between two different views of the world. One view of the world is the view of the world that was espoused by the monoline credit card provider Capital One when it first came in. And what they did was they went to previously underserved or marginalized populations and then did a little bit more data work and then tried very hard to credit screen more effectively using then what was state-of-the-art technology, which was essentially statistical models, to try to effectively discriminate within the sets of underserved borrowers to try and provide credit to those that were deserving. And in that sense, what they managed to do was to, in some ways, expand the credit frontier by doing that. Now, a sort of somewhat more dystopian view is put forward by many people, and I guess one exemplar of this is Cathy O'Neill's recent book, which is called Weapons of Math Destruction. And essentially the idea there in that book and in many other sort of more dystopian views is to claim that the problem with new screening technology is that, in fact, what it will do is to find a way to exacerbate pre-existing inequalities in society. And one way that it might be able to do that is to, in fact, take pre-existing data, take the biases that have been embedded in pre-existing data, and then in some ways amplify those in the algorithmic process. Now, so really this paper is about sort of trying to attack this question in the domain of credit screening, essentially, and to really think about these questions. So what do? We have, fairly simple theory, which is trying to understand the distributional implications of better statistical technology. So what I will do to begin with is to outline this very simple theory for you. There's more formalism in the paper and in the appendices to the paper, but really everything that we want to do is easily described in a few graphs. And we'll sort of try and think about what happens when you have better statistical technology, which is the way we think about machine learning, being introduced into a sort of pre-existing world which has relatively inferior statistical technology. What we're then going to do, because the problem gets very nonlinear very quickly and it's hard to solve in closed form, is to actually go out there and use conduct an empirical application. So we use large US administrative data, which was, is quite granular. And then we actually run these models on the data. We run some traditional sort of logit style credit screening technologies, as well as a machine learning, a sort of suite of machine learning models, just to shed light on whether some of the aspects of the theory actually come out of the data. And then we sort of look at what the distributional consequences of the new technology are in this scenario, in this data set. Using some out-of-sample predictions, we evaluate this particularly across racial groups. This is the distributional sort of characteristics that we're interested in particular. And what we find in our setup is that it does seem like there's some truth to the sort of O'Neill view, which is we find that there's fewer winners in some minority groups and increased dispersion of both rates and acceptances across these minority groups. So it's important to sort of recognize that it's not necessarily an incredibly rosy picture across the board, although there are, of course, good things as well from this access to new technology. And then sort of almost as a back of the envelope exercise, we try and explore the equilibrium implications in a world in which there's a model of competitive loan pricing. So of course we have some reduced form sort of empirics, but then we're going to embed that in a model and try to get a bit more structural with our exercise and then show you what counterfactual outcomes might look like in a world in which these machine learning technologies are being used. So just to sort of jump into our basic theory, what you want to think about is a lender's prediction problem. And in this lender's prediction problem, the lender observes borrowers with characteristics X. So this could be a vector or it could be a univariate characteristic. I'll show you some graphs with a univariate characteristic. And the lender is trying to predict default outcome Y. And so you can really think about this, if you like, as a 1-0 or just a probability of default. Okay. So the idea is that the lender wants to predict Y hat, which is B hat of X, to minimize the mean squared error in that prediction. And what we're really going to do is to look at a comparative static across technology. And the way we're going to model that comparative static is to think of the old technology as being a restricted class of functions. So for example, you might be restricted only because of the fact that you have this primitive technology to only run linear regressions that connect default to characteristics. And then the new technology we're going to model as having access to a wider class of permitted functions. So it's kind of like what happens is, you know, people come down from heaven and then suddenly give you a quadratic technology that you didn't have access to beforehand. The lemma that we will show you is that optimal predictions with new technology are a mean preserving spread of those with old technology. This is very easy to understand because if the new technology is more flexible, of course, it's going to improve the R squared in that regression. And that means that if it improves the R squared, you're going to have a bigger dispersion in the fitted values of the prediction, which will mean that there are winners and losers. So let me try and illustrate.
Sorry, Tarun, just a question. So you don't do anything regarding the explosion in terms of the X. So the X also over time has been increasing, right? So we now have that all these companies can purchase data regarding investor or individual characteristics. So do you have any comment on that?
Absolutely. This is a good question. So that's absolutely right. We're going to assume that we have a fitted, a fixed set of X in this paper. So if you want to think about sort of expanding the footprint or the sort of, you know, looking at digital footprints and trying to use additional variables, there are other great papers like the Berg and Puri and et al. Paper that does this kind of work. In our paper, we're really more interested in how the technology can be used to take pre-existing X and then turn that into something that might be better. Now, of course, the set X is going to expand because suppose I think about interactions within the set of the pre-existing X variables that you have, the right-hand side is going to expand, but it's not going to expand because you're bringing more variables to the table in our setup here. Okay, great. So thank you for that question. That was a much needed clarification. Okay. So let me try and sort of explain to you kind of what this means in a very, very simple example where think about a single X characteristic, and let's assume that that's just the income of the borrower or something along those lines. And now what we're trying to do is to predict the default probability of the borrower on the Y-axis using that single X characteristic. This is just for illustrative purposes. Of course, we're going to think about a much wider group of X's in our empirical application and even in our theory. Now imagine that in this sort of primitive world, these people that are trying to predict the default probability using X have access only to this linear technology, and they're only able to fit the dashed line that's over here. Now, these people are going to find that as income increases, the default probability decreases. That's the way we're setting it up in this hypothetical, but it seems plausible. Now imagine that what happens is that, a new technology is suddenly given to this economy, and let's assume that this new technology simply allows people to fit quadratic functions rather than fitting linear functions. Now in this world, let's assume that what happens is that the best predictor in the class of quadratic predictors shows you that the default probability is in fact convex quadratic in the underlying X characteristic, which is income. Now, the shape doesn't have to be this way. We're simply drawing it in this way. It could be anything. I mean, it could, of course, be exactly the opposite. It could be sort of, bowed downwards and so on and so forth. But let's just assume for argument's sake that this is what it looks like. Now, immediately what we can tell you is that what's going to happen in this world is that there's going to be a class of people who will win and other people who will lose from this change of technology. The people who win in this place are the people who, from the old technology, which was linear, have a reduced default probability under the quadratic. And these are all the people where the solid line is below the dashed line. However, there are people at extremes of the X characteristic, either very low income or very high income in this world, that are going to have higher default probabilities that are predicted by the new technology, and so these people lose. Now, how do we overlay distributional consequences onto this? Imagine that there are two groups of borrowers. There's the blue borrowers, which have a much more dispersed distribution with the same mean as the red borrowers that have a much more tight distribution over here. And so what's happening in this world is, clearly, when you move from the old technology to the new technology, the winners are disproportionately in the red category, and the losers are disproportionately in the blue category, because they're much more frequently represented in the tails of the distribution. So what's happening here is, as you change technology, and as you look at which group benefits and which group loses, you see that in this world, the convex quadratic penalizes people who have high variance on the X characteristic. In fact, it's possible to prove, which we do in the appendix to the paper, that if you have continuous functions, okay, and if you have multiple X variables, and if you have, higher dimensional functions, as long as, you can do some simple math to show you that there's going to be a very close relationship between the higher order derivatives of the function that you estimate and the higher order moments of the characteristics group by group. So in exactly the way that here you have a second order polynomial and you've got the variance, if you had a third order polynomial, it would penalize skewness, fourth order your kurtosis, and so on and so forth in that way. I mean, the sign of the derivatives are going to interact.
So sorry for interrupting, Tarun. I have just a quick question. But so does this mean that the linear technology is in the linear technology, you basically have that the people at the extreme are subsidizing the other ones?
Yeah. So a different way to think about that is that in this particular world, now we'll get to the reasons why. But let's assume that P hat NL is actually structural, right? Then essentially what's happening is there's an implicit subsidy provided by quote unquote poor technology to blue borrowers in this world, right? So that's quite right. Now, of course, the story could be much more complicated, which is it might not be structural, right? And that's precisely the case that we're going to talk about next. Okay, so great. So this example, which I just showed you, now, of course, it sort of depends a lot, right? So the function could look like this, the distributions could look very different, but in this particular example, this is how we've set it up. Now, this example could arise from y is equal to p of x plus epsilon, okay? Which means where p is nonlinear and the group G does not matter for y. That is to say that all that's happening here with the introduction of the new technology is it's more closely approximating the structural relationship between X and Y. So the new technology is just getting better at capturing the underlying structural relationship between the X characteristics and the Y characteristics. And so why do winners and losers arise in this world? They arise because there's more flexibility of the new technology to pick up what's actually lying in that cloud of points, which might be the true relationship between X and Y. And in this case, the effects across different groups depend on the functional form of the new technology and the differences in the distribution of the characteristics of the two groups. Now, that's a fairly benign scenario, but you can think of something that's a little bit less, benign, something that's a bit more troubling. Now let's think about a world in which the true relationship is actually y is equal to a linear relationship with the x characteristics, but that's for some reason there are group-specific means that are different for the two groups in terms of their default, expected default probabilities, okay? So G is now predictive of default for whatever reason. It may be, for example, there are other variables that G is capturing. There are historical circumstances that G is capturing that are unobservable. There may be any number of things. But now, in this world, what happens, well, it's going to turn out that the effects of the new technology arise because essentially you are unmasking who G is using observable characteristics. Yes?
Sorry, Tarun, we have a question from Daniel Wu, and he's saying, would it make more sense to label winning and losing groups in terms of loan outcomes, so loan decision and rates instead of default prediction?
Excellent. So what we're going to do is, that's precisely what we're going to do in our equilibrium model. For now, we're simply thinking about this as default predictions or probabilities of default. But you're quite right that it doesn't have to be necessarily the case that default probabilities map linearly into decisions about inclusion and exclusion, or indeed about rates going up versus down. But what we'll see is that is generally the case as we go later. So, right now we're using the terms winners and losers to determine probabilities of default. But of course, more rigorously, you would do that with rates and so on, which we will do later in this exercise. Okay. So let's think about what this more dystopian sort of scenario looks like. So in this world of triangulation, imagine that the true structural default probabilities for the two groups are in fact linear. So the blue group in this case has this sort of high average default probability. The red group has the low average default probability. So their intercepts are different, okay? But essentially they have exactly the same linear relationship with the same slope as far as income is concerned. Now, in this world, the linear model, all it's going to do is it's going to try to fit somewhere between, because it doesn't have G in it, it just fits Y on X. So it's going to just sort of, fit somewhere in the average, assuming that the two group populations are roughly the same size. You're going to fit closer to one versus the other, and that's what's going to happen. But it doesn't have any ability to do anything more than that. But the nonlinear technology in this world is actually going to do this, and you can prove this. What's actually going to happen is it's going to essentially infer, okay, that when you're in the tails, you're more likely in the presence of the blue group. So you want to move towards the blue group probability on average. And so essentially you'll recover again this nonlinear convex quadratic form that we showed you earlier. But now this is for a less benign reason, which is essentially you're kind of, undoing the effects of the anonymization of G and recovering that from the distribution of G versus B, that is blue versus, of blue versus red. Okay, essentially, that's essentially what's happening here. So then there's a second question here, which is, even if we did find effects of this new technology being differentially sort of allocated to the two groups, where is that coming from? Is that coming from, this kind of structural flexibility that you're permitting the model to have, or is it coming from this, less benign triangulation source? This is another question that we try to tackle in the paper. Okay, so now it turns out that, it is not the case that machine learning is fitting these lovely smooth functions, as we all know, right? Machine learning is fitting these very jagged functions. They're fitting complicated step functions. They're not necessarily continuous, okay? It's also the case that the distributions don't have to be these beautiful, smooth, normal distributions either. They could be very complicated, bimodal. There could be any number of things going on. So going as far as this with closed form solutions is possible, going much further than this intuition is going to be very hard. And so what we then do is we say, look, let's go to the data. Let's get this big data set where we can actually try and test what these questions look like. And it turns out that in the US, we're able to do this. So in particular, what we do is we use the data in the Federal Reserve Bank in New York, and this was when both Paul and Andreas were working there. And so, this is from that source, which is we use the Home Mortgage Disclosure Act HMDA data. Inside the Fed, this is merged to the McDonough Black Knight data. The Home Mortgage Disclosure Act data gives us application date, applicant income, loan type, size, and purpose. And for our purposes, very crucially, the group identities, which we're using race right now and ethnicity, which you could, of course, think about a different way of doing this. You could do gender, you could do anything else. Our method is very much generalizable to those sorts of cases. And then what you also need, of course, is you need something on default status and default performance. And so inside the Fed, they merged this to the Black Knight data, which is underwriting, contract, and performance data like FICO, LTV, the interest rate, and pretty importantly for us, the default status on these loans. And so that merge is done, and that's the merge data set we use. When we look at the linked data set, this has 9.4 million mortgage loans that we look at that were originated between 2009 and 2013, but we track their default performance all the way out for 3 years past that point, which is up to 2016. These are portfolio and GSE loans. They're generally less than $1 million in size. And our definition of default is the usual one, which is 90 plus days delinquent within 3 years of origination. Okay, so that's really what we're looking at in this case. And so we're going to try and predict these sorts of things. Now, let me just show you a very small set of descriptive statistics of these data just to give you a flavor for what's going on. So in the data over the sample period, there are these default rates, and these are across race. So we can divide this into Asian borrowers, white non-Hispanic borrowers, Native American, white Hispanic, and Black borrowers. And what you see is that the average default rate, as you can see, there's dispersion, considerable dispersion across the groups. So the mean default rates vary across groups. So, you know, already you're in this situation potentially where the intercepts are quite different across the different groups. And so that's something to just keep in mind with the sort of theoretical intuition that we've developed. And Asian borrowers have sort of on average a lower default rate, and, you know, Black borrowers have a substantially higher default rate. And then you're sort of going with Native American and white Hispanic being slightly higher than white non-Hispanic, which constitutes the majority of the population in this case. If we were to look at the FICO scores across race, then you start to see that, yes, there is a relationship. So for the Black borrowers, they have on average lower FICO scores, okay, relative to white non-Hispanic borrowers. There's about a, you know, roughly a 25 to 30 point differential on average between white non-Hispanic and Black borrowers. And then the Asian borrowers are sort of slightly higher than the white non-Hispanic borrowers. But getting back a little closer to our theory, if we were to look at the standard deviation of the FICO score across race, again, you see that the dispersion in the Black group is considerably higher, again suggesting this is very similar to the blue distribution that we saw earlier, whereas, you know, a tighter distribution, for example, is the Asian or the white non-Hispanic borrower distribution, and this is for the characteristic FICO. Okay, now, you know, of course, you could do the same thing for income and for any of the other characteristics that we look at as well. Now, if you look in the data at the granted interest rates across race, and here what we've done is we've just demeaned all these rates with the average spread at origination of these loans, you see that there's already some sort of pricing that takes this into account in the data. Black borrowers are getting, you know, about a 10 bip or 15, you know, roughly 12 bip spread higher at origination, and Asian borrowers are getting about 7 bips lower spread at origination. Sorry, 0.7 bips spread at origination, that's low. Okay, so this is, you know, sorry, that's 7 bips, that's exactly right. So this is about 10 or 12 bips, and that's 7 bips, and that's what it's looking like. And of course, since this is the majority of the population, this is at about 0 for the white non-Hispanic borrowers in the data. Okay.
So just I know that this is not what you're doing, but if you were to condition, for example, on income and create very small buckets, would you actually see kind of dispersions across races, or not so much? I suppose that you were focused only on people that had income between $100,000 and $110,000 for all the different races. Would you actually see some dispersion of spreads at origination?
Of spreads at origination? That's a good question. I think that question is tackled to a certain extent by Bartlett, Morse, Stanton, and Wallace, who are doing some work on precisely that sort of question. I think they would argue that you do find some differentials there. I mean, that's a different exercise, of course.
Yeah, exactly.
Yeah. But it turns out that it's a little difficult because there's also differences in the way that points, for example, are allocated and so on. But, you know, I think if you're looking for an answer to that question, which is a great question to ask, and I think they interrogate that pretty carefully, theirs would be the paper to look at on that front. And to be very clear, that's more in the sort of, you might want to think about that as being and I think they would explicitly claim that that is a test of taste-based discrimination across lenders. Whereas what we are trying to do is much more in the tradition of statistical discrimination, to try to think about inferring from underlying characteristics of borrowers what their default rate should be. Okay. So what do we do with these data? So what we do is we actually just take these data and then, we essentially connect these default rates to a wide range of X characteristics that we also have in this data. In our main applications in the current draft of the paper, which has been revised, we don't do this with interest rates on the right-hand side, just to be very clean about the way that we're making these inferences. But it turns out it doesn't much matter whether you put interest rates in or you don't. And for our structural exercise, we'll need to do that. But essentially what we're going to do is predict default rates across, for everyone in the data using a range of different variables, but not using race, which is explicitly prohibited by the law. So you can't do that. But of course, as an econometrician, we can do that, and we can actually ask questions about what would happen if you did that, and we will get there in a second. So how do we estimate probabilities of default? So the comparison we're really looking for is across these technologies. So, you can really think about the linear technology, which we contrasted with this quadratic convex technology. And essentially that's the way we're going to do this. We're going to contrast what we call traditional technologies with machine learning technologies in exactly the same comparison way. And the traditional technologies here, we're just going to imagine that we're modeling probabilities of default as a logit function. And of course, a logit function is, if you think about sort of in a two-dimensional characteristic space, it's going to be a linear. The decision boundary is going to be linear. So in that sense, it's not very different from the linear case that we've already considered. So in this case, we are modeling the probability of default equals a logit. And then we're going to use these very flexible and many nonlinear bin dummies for FICO, LTV, and income. So we're allowing for, those dummies to sort of come in. So it's not as though we're simply, constraining this logit technology to be a very primitive technology. We're actually sort of doing stuff that's a little bit closer to the way that the lenders might actually do these things in the data. We then contrast that with machine learning technologies, where we're sort of essentially going to rely on tree-based models. So for those of you who are aware of tree-based models, this will all be very, very obvious to you. But the way to think about a decision tree model is, suppose I had a characteristic X1 and a characteristic X2, imagine it's income and it's FICO. Essentially what tree models do is, they're flexibly going to put in kind of, dummy variables in here, okay, which are essentially going to capture interactions between X1 and X2 that divides up the space into where you would find the Y variable. That is to say, a default or bad, okay, might lie between points L1 and L3 on characteristic X1 and 0 and L4 on characteristic X2 and so on. So they just flexibly partition the space, these step functions in multidimensional space. So of course, you can get a little bit more complicated with these tree models, and we do, which is they turn out to be very good at fitting the data, but they have a tendency to overfit the data, especially for out-of-sample validation. So what you can do is to try and apply some bootstrap aggregation techniques by taking randomly sampled copies of the data and by randomly deleting features at each step. And this is what the random forest does. And we cross-validate this technology in the usual machine learning kind of way. We also use a machine learning technique called calibration, which is confusing because, of course, calibration means very many different things. And we're going to do some other types of economic calibration. But here, calibration is about sort of essentially smoothing out the probability distributions that you get from these machine learning technologies. We can talk more about that if there are questions. Now, we don't just rely on random forest. It turns out we can use XGBoost, which is another pretty common, Kaggle competition winning technology. And it turns out our results are very similar if we do that. Okay.
And so Tarun, like what I think that the machine learning tools you're kind of working with would be probably considered like within the classical machine learning tools. Now there is a more and more emphasis into deep learning tools, for example, and neural nets that have higher layers. Did you try? I mean, they seem to be very, very powerful when you have huge amount of data, which seems to be the case. But maybe yours is not big enough. I don't know. I don't know if you have enough features.
Yeah, I mean, I think the thing that we try to do. I mean, one of the biggest problems, of course, is that when you have a heavily unbalanced data set where there's a very small fraction of defaulters, that actually makes it hard for any of these techniques to perform well. So it's going to turn out actually that the thing that really helps us is calibration. And it turns out that this is relying on some CS work that shows that calibrated trees turn out to do better in out-of-sample prediction than almost any standard machine learning technique, including neural nets and deep nets and things like that. So, so the combination of the calibration and the tree helps us really go quite far over here. But you're quite right that, an easy extension would be to try and see whether our inferences still apply when you use, more complicated deep net neural networks and so on and so forth. So the explanatory variables that we have in the model, so of course the left-hand side is default. Did you default? Did you not default? The explanatory variables that we use in either the simple logit, the nonlinear logit, and then these are common covariates. We look at income, the LTV, and FICO. These are then converted into these narrow bins in the logit. We try even narrower bins in robustness check exercises and so on. And then the common covariates that we have across these models, as well as the machine learning models, is the spread at origination. So this is the rate. Now, in most of the stuff that we're doing in this draft of the paper, we eliminate the rate from the right-hand side, but I've just put it in there because it's going to come up again in our calibration exercise. So you can sort of think about us not using this in the baseline specifications. Turns out it doesn't make a huge difference to our inferences. And then if we have the size of the loan, the documentation type, occupancy type, is it a jumbo, dummies for various loan types, loan term, what's the funding source, do you have mortgage insurance, which state are you in, what's the year of origination, and so on and so forth. Okay. So what do? We estimate these models, the machine learning model, the simple logic.
Tarun, there was a question from Sahid who's asking, do you consider religion? I guess Hamda doesn't have it, but
yeah, Hamda doesn't have it actually. But and in fact, I'm pretty sure that would be in the class of prohibited variables that you would not be able to use. So remember what we're going to do in this exercise, and I think that question is appropriate, because what we wouldn't do, what we are doing in this exercise is we're not using race on the right-hand side. We're not using gender, none of the excluded variables. We're sort of thinking about this as the way that a lender would approach the prediction problem. And then once you do the prediction problem, we're going to evaluate what those predictions look like for different race groups. Now, of course, if you wanted to do that with religion, you could do the same thing, do the exercise, and then check whether, for example, algorithms have this tendency to discriminate against or towards certain types of religions. I think that's a perfectly valid type of way of approaching this. So we estimate the data on the training set, which is 70% of the data, and we leave out about 30%, and we evaluate everything. So everything I'm going to show you is really on the test set, essentially. The out-of-sample performance that we find, it sort of it depends a little bit, but it's about 14.5 to 15.3%. Okay, and so the R-squared goes up with the machine learning model relative to the standard model. Now, R-squared is not usually a great approach to sort of evaluate these things, but it's something that we know of well. The precision score goes up by about 5.4, between 4.5 and 5.5%. And that really answers the question, how many predicted defaults are true defaults? And when we use the machine learning model, it does improve your predictive capability. It seems more accurate. And then we do a bootstrap analysis to confirm that the differentials in these predictive performance are significant with a good p-value. It's less than 0.03 or it's even smaller. So the random forest method, we conclude, is a pretty substantially better predictor of default. I mean, the differences are not enormous, but they are very precisely estimated, very statistically significant. And so it is the case that a lender would prefer to use this technology relative to the old technology.
Tarun, we have Abdul Reza is asking, how about the ROC curves?
Absolutely. So all of that is in the paper, the area under the curve and so on and so forth. And the area under the curve does improve in our method as well. The reason we're using precision here is that for unbalanced data sets, the area under the curve is not really the best approach. So you can get high AUC increases when you have very small numbers of minority class observations. but the precision recall is a better metric in that case. So we also look at the area under the precision recall curve, and I'm showing you the precision score here. We also look at the Breyer score decomposition. You know, there's many different types of approaches we do, and almost under all of them, you also get an improvement in performance, including the EHC. Okay, so let me just give you an example. So now let's go back to our question about race and sort of ask this question about whether these technologies are in fact giving you differential predictions for different racial groups. And I think, you know, a good way to sort of show it is to describe our diff. It's kind of like a diff and diff. What happens when you change technology? Okay, now it's not a diff and diff in the classic sense because we're not doing identification, but you really want to think about changing technology, changing race, what happens? Okay, so in this sort of 2x2 box is the way you want to think about it. So let me just give you an example, which is a two-dimensional example rather than the 1D example I gave you later, and this is from the data. So we're going to fix all characteristics but income and FICO, and we're going to do that for, you know, a very restricted subsample of the data for illustrative purposes. So you should not take the magnitudes as being important in this exercise. Is there another?
So, Tarun, we have another question from Elisa saying, when we predict default using logic model, people always question the power of the test since default events are relatively rare. Does this type of concern apply to the situation when you use machine learning?
Yeah, absolutely. So this sort of rare, you know, this unbalanced data set business, which is that you're predicting rare defaults. This is precisely what, in some sense, many of these approaches are trying to hit. Logit, of course, is not very good at this. Machine learning, also uncalibrated, is not very good at this. When you start to calibrate these models, they really start to come into their own. But these are all standard ML techniques to try to get things to look better. And they do look better. This is one of the reasons why you get these performance improvements. So hopefully that's helpful. Okay, so let's fix all characteristics with income and FICO, and we're just going to do this sort of 2D on income and FICO, like X1 and X2. And let me just explain what this looks like. So what is this telling us? This is telling us that suppose I were to take a slice of the population, fix all of their other characteristics, and then just graph them in 2 dimensions, their income and their FICO score. Okay. Now, if that was the case, then what is the Logit technology telling me? It's telling me that here, there's a region of very high default, okay? High average probability of default, 0.5 here. If you have income less than 50,000, okay, and FICO score less than about 675. That's not 50%, that's 0.5%, okay? So this is a small default, okay? Now, of course, again, as I'm saying, don't interpret the magnitudes. This is on a very limited slice of the data. This is really to show you what the shapes look like, okay? Now, with a nonlinear logit with step functions, all it's doing is, in a logit in 2 dimensions, it would just be straight lines coming across here. With the step functions, you're just able to fit these step functions, and then they're essentially going to be increasing, you know, sort of increasing creditworthiness, decreasing creditworthiness, lower probabilities of default, higher probabilities of default. What I've overlaid here is what the distribution of white non-Hispanic borrowers looks like in the space of income and FICO for this cross-section of the data. And what you can see is a lot of the mass is really sitting at about $75,000 of income and sort of close to 790, 780 FICO. Okay, so this is really what the mortgage borrowers in the data who are white look like. So again, just like the blue distribution and the red distribution, this is the heat map of the white non-Hispanic distribution in these 2 dimensions of FICO and income. Now what I'm going to do is 2 things. First, I'm going to introduce what the contour lines look like for the random forest. That's what they look like. And immediately you can see that there's a lot of flexibility, and these shapes don't look this sort of rigid shape that you have here in the logit. They're essentially sort of, you know, really kind of quite jagged. They bow out in certain places. They sort of look in certain places. It's all very different from the logit. And in fact, you know, you can see that the regions look quite different. Now, in this particular example, you can see that it's telling you that some of these borrowers are in fact more risky than you thought they were under the old technology here. But now you sort of want to do the second difference, which is you want to ask the question, what happens to the black borrowers? Well, it turns out this is what the mass looks like for the black borrowers. And so essentially when I change technology, these borrowers are getting penalized more because the random forest is essentially telling you that the portions of the distribution in which they live are actually the bits of the distribution that are considered more risky. by this model. And that's really the way to think about what's happening in our setup. And this is just an illustration, but I think it's quite a useful illustration of what our approach is doing. Any other questions before I go to this plot? Or
yes. Is it right to think that machine learning model penalize the distribution that are non-direct delta that are not direct delta functions?
So I wouldn't say that, because I mean, suppose you had a distribution that had point mass in a particular place. I mean, it really depends on what the shift of the PD distribution looks like at different points in time. So, you know, for example, it really depends on what the random forest is telling you relative to what the logit is telling you. Now, if there were a point mass, I would imagine that there wouldn't be any differentiation between the probabilities of default, because if characteristics all look identical, then I wouldn't expect to see much variation in the rates. In the rates of default across those populations either. But essentially what this is telling you is if the mass is shifting more into these areas, which the random forest penalizes more, then you get these potential distributional consequences. Now, a better way to see that across the entire data set, and this is in some sense the kind of central plot of our paper, okay, is really to take the percentage difference between the probabilities of default that are given to you by the random forest model relative to the probability of default given to you by the nonlinear logic model, okay? So the way you want to think about it is, as I move to the right of 0, the random forest is telling you that you're more risky than the nonlinear logic was telling you that you were. And as I move to the left over here, you were actually more risky under the logit than you were under the random forest. Okay, so it's going the other way. So, put differently, the people who are on this side, okay, are the losers from the introduction of the new technology in the sense of their PD is going up, and the people on this side are the winners from the introduction of the new technology because their PD is relatively going down. And what you can do is you can plot what the cumulative share of borrowers of each race or each racial group looks like in this space. And what you can see is for white non-Hispanic, for white Hispanic and black borrowers, it's about at 50%, which is the median. And what is that telling you? Roughly an equal share of people gain and lose under the new technology. However, and this is where the differential comes in, that is not true for the Asian and white non-Hispanic borrowers. A much larger fraction of them disproportionately win relative to lose under the new technology. So this is creating space between these two groups. So when the new technology comes in, the white borrowers, the Asian borrowers disproportionately benefit relative to the black borrowers and the Hispanic borrowers. And that is really, in some sense, the sort of story of what's going on in PDs. Now, of course, many of you are probably getting quite impatient because, of course, PDs don't mean rates don't mean exclusion, loan doesn't mean, So, why do you keep talking about winners and losers in terms of probabilities of default? And it's precisely to answer that question that we set up a model. But before I go there, I want to just talk to you for a second about whether these changes are coming from flexibility, which is accurately mapping the structural default probabilities, or triangulation, which is actually, that case of where you had those two different lines with the different intercepts and trying to figure out or unmask who the minority borrowers were. So we did this in a very simple way. We first add race as an explanatory variable to the logit, and then subsequently allow the use of the ML technology to the model with race. That is to say, it's almost like adding nonlinear functions or adding interactions of X explanatory variables, and the order of the decomposition is going to matter. Because suppose I did, technology first and then added race, that would be different from adding race first and then technology. We do it both ways and we come up with very similar results. And essentially what we find is that most of it is coming from the added flexibility of the technology. It is true that some of it is coming from the triangulation, but it's a relatively smaller fraction. Now, of course, the way that we do this here in this table that I'm showing you is that we're just adding race as an explanatory variable. You might think a better way to do this is to interact each of the explanatory variables with race in the logit model and then add technology to it, because you can do it in 2 steps. And if you do it that way, it turns out the triangulation is actually bigger. It can go up to about 20% in those kinds of settings. And that's in our current draft of the paper as well. But yet it is still the case that about 80% or more of the gains are coming from the better technology, the flexibility of the technology to uncover underlying relationships. Now, what does that mean? It actually does mean still that there's something not so palatable going on in the data, which is that, there's some pre-existing unobserved heterogeneity in the data that this is capturing, essentially. It's mapping this more accurately structurally, but you're still asking the question, you should still ask the question, why are the X characteristics for minority borrowers so different from the X characteristics of the non-minority borrowers? And I guess that's a very live issue. I mean, we are now seeing, even in this pandemic, that there are, the inequalities of income, of wealth, and all of this are translating into really terrible outcomes for minority populations around the world. And so this is not a reason to not be concerned. It's just an attribution exercise that we're doing here. Okay. So now back to this question about embedding these things into a model. So what I'm going to show you in the remaining 10 minutes or so is this back of the envelope exercise that we do. So what we do is we have a very simple two-period model where what we're saying is, imagine that the NPV on a loan given to a borrower with characteristics X with interest rate R is going to equal the present discounted value, discounted back at the WACC, the weighted average cost of capital of the lender. And there are two possible states. One is the borrower defaults here with probability P, in which case you recover L tilde, or the borrower doesn't default and pays you back 1 plus R on the loan. Okay? And so, you subtract off the loan that you initially made, and this is what the NPV on the loan looks like. With Bertrand competition, okay, across lenders, the equilibrium R star from this equation is going to solve NPV equals 0. If there's perfect competition in prices across lenders, and you're in a competitive loan provision market, this is what's going to happen. You might imagine extending this to have non-competitive, and things like that, but, we don't do that in this particular setting. Now, here's the innovation. The innovation is the PXR, okay, is what we actually estimate in reduced form from the data. So we feed that into this NPV model, and we can solve borrower by borrower for the rate that solves this equation, conditional on the function that's put in here. And you can solve under this function for the logic model, and then you can also put in for that function the one that you got from the ML model. And that's really at the heart of the exercise here. And essentially what's going to happen is there are going to be some cases for which NPV X comma R is less than 0 for all feasible R. That's when we get rejections. Okay? We essentially say we can't find any interest rate that's going to make NPV 0, so these borrowers are going to get kicked out and not given a loan.
I think we have lost Tarun for a second. It's going to be reconnecting soon. Just hold on.
Hello, can you hear me?
Yeah, now we can. Yeah, we lost you. We lost you for 30 seconds. I think, yeah, you were before. Yeah, so I think we lost the last minute of what you were saying.
No problem at all. But did you,
okay.
Did you get the NPV equals 0 setting here?
Exactly. Yeah. That we got. Yeah. That
you got.
Right after that.
And then the one thing that I was saying is that we have these reduced form probabilities of default functions that we estimate from the data. Part of that, you could either do that with the logit or with the machine learning, and we're just going to plug in for that. Now, of course, you might imagine that these reduced form functions that we get are not actually the structural functions, okay? And there are going to be some inference problems associated with that we will then try to deal with. And so that's going to be important. Now I'm using calibration in a different way from the way I used it earlier, but this is the way we use them in models rather than in machine learning exercises. So we're going to need to plug in for some parameters. We plug in some value for the recovery rate, which basically comes from industry standard, which is assuming a 25% haircut on the value of the house, assuming that there's some, 10% cost from foreclosure costs or whatever it might be of the loan size. We're going to assume that the WACC is essentially that which sets to the quarterly average interest rate, assuming that there's about a 30 basis point markup on the average loan. And we're going to convert the 3-year probability of default to a lifetime probability of default to fit in with our 2-period model via standard default assumptions. All of these details are in the appendix to our paper if you're interested. Anyway, When we do this exercise, okay, the big problem, of course, is an identification problem. In the data, we only observe one interest rate per loan, but likely it's not randomly allocated. It's not as though you're going out there with this data which just randomly drops interest rates on people and checks their defaults, and then you're structurally estimating that from, you know, using your reduced form functions. So obviously there's going to be some biases associated with the fact that what you've actually done in this case is, you know, there may be some unobservable variation that's driving the interest rates that are actually offered by lenders to the data. So our proposed solution is to de-bias the estimates that we get from the data. So we do this in two ways. We just restrict our attention to, you know, loans for which we don't think that this is going to be much of an issue, where there's just selection on observables, hard information, GSE full doc loans, okay? And then we also adjust DP hat over DR downwards using the ratio of causal to reduced form estimates based on some causal work that Andreas did with Paul Willen in 2017 in the AEJ paper. And so we do this, you know, we think this is a nice contribution as well. It's very much in the appendix. It's a little bit technical, but it allows us to sort of connect the causal PDs that we estimate, used form PDs that we have here, and de-bias them. And we de-bias them, we recover this factor 1.7 and de-bias the estimates. Anyway, what do we find when we do that? We find that the acceptance rates from both the random forest and the logit can be compared. So in the logit model, which is the blue bars here, you find sort of, you know, a differential acceptance rate across borrowers for sure, okay? 92.4% of the Asians in the data would have gotten accepted under the logit model, 77.7% of the blacks. There is that differential. Now, of course, that differential also exists in the random forest. What you immediately will observe is that the random forest is giving slightly higher numbers of loans to everybody, okay? So on the extensive margin, it is true that the capital one work is actually fair, you know, that intuition applies here, which is the random forest is giving slightly more loans to everybody in the data. And that's pretty nice, okay? Lowever, the cost of that is that the average spread at origination differs dramatically in the random forest relative to the logit. The logit model is going to generate this differential between blacks and Asians or blacks and white Hispanics that's pretty big already. But you can see that that differential is massively expanded by the random forest, substantially higher rates on average for blacks relative to the spread, to the origination average, and substantially lower for the Asian borrowers, and substantially, you know, quite a bit lower for the white non-Hispanic borrowers. So that differential across groups in the average rate, when you plug it into this simple equilibrium calculation, is also large. The standard deviation of Sato increases dispersion. There's dispersion across groups, but there's also dispersion within groups. So the rates that they get are also much more variable. So if you were a borrower behind the veil of ignorance, you would much rather be drawn from a distribution that has lower variance than one that has much higher variance. And this is another important feature of what comes out of this exercise. There's some other statistics here about inclusion and exclusion and equilibrium. So the thing that you might want to think about is what's the average spread for those that are included if they're white and Asian borrowers. And it turns out that what's happening is you're getting more people in the model, okay? You're saying, I'm going to give you credit, but on average, I'm going to give it to you at a higher rate than I gave it to you before, even for white and Asian borrowers, okay? And you can see that that's even greater to an extent for black and Hispanic borrowers. I'm going to give you more credit, but the credit I'm going to give you is going to be much more expensive. So that's also an important aspect of what's going on. Okay, so, you know, instead of sort of boring you with the standard deviation of the Satos, what I'll do, given I have a few minutes left, is to conclude here, okay? And then maybe we can take some more questions if there are any. So, improvements in statistical technology, what we've tried to show is that it does create greater predictive power and gains for producers, but at the cost of increased disparity in outcomes for consumers, okay? So fintech, you know, has some benefits, but it does also clearly have costs, especially if you are people who are coming from a minority population. Black and Hispanic borrowers on the US market data bear larger changes. Okay, there are some first moment effects. They're more likely to be perceived as high risk and get higher rates. There are second moment effects. There's a greater increase in the dispersion of outcomes. And the improvement comes from more than just putting race into the model. There's this access, you know, the technology is actually doing something. There are equilibrium effects here as well, okay? There's some positive extensive margin effect of the new technology, but the unequal effects persist at the intensive margin. So I'll stop here and see if there's any questions that are from the audience, but that's what we have in this paper.
Yeah, thank you so much, Tarun. Please feel free to raise your hand or write your questions in the chat. In the meantime, I have a couple of questions for you. The first one is kind of more, not technical, but like it's more curiosity. So out of all the regressors you use in this random forest or boosting, so which ones are the ones with the highest relative importance? So which ones are picked up to be the most important? And the second, this is kind of a broader question, is related to how much are banks already using these tools? As far, I mean, we know that people are being arguing, or banks are being arguing that they've been using it for many years, but it's not clear which banks are using it, how they're using it. And do you see any kind of scope for new regulatory interventions in this area?
So let me try to sort of take your second question first. So the second question, I think, which is, so I think there's been some great work by, Buchak, Saru, and, so I think Amit, gave the seminar in this forum earlier. There's also been some great work by Andreas and, James Vickery and others that's also in the RFS that shows that fintech lenders are doing a lot of work on the processing side. There's lots of process improvements that they're generating. As to the question of how much they are using the technology in the credit screening approaches, I think the answer is it has been fairly low, but rapidly increasing. It's probably my sort of, anecdotal impression of what's been going on. What that suggests is that while this paper is outlining this fairly dystopian scenario, it's really one that we expect might materialize going forward unless we are careful. So that's really the way you want to think about what's going on.
Okay, so go ahead, sorry.
No, not at all. If there's another question, I can take that.
Yeah, let me actually give the word to Koz. Koz, I'm gonna unmute you.
Hi, Tarun.
Hi, Koz. How are you?
How are you doing? So, when you look at the effect of technology, my question is, should it not be? So, let's say I'm a black borrower and you're not allowed to include race as a variable, but shouldn't the real question be that given my actual probability of default, how much is the introduction of new technology making me lose unfairly? That means, there is a, I mean, if you could, there is a true probability of default and the new technology is unfairly disadvantaging me, or it seemed like your benchmark was, just introducing new technology. It of course has great higher predictive power, and that would make me lose compared to a scheme where I'm only using the logit model. I don't know, right. Somehow I'm thinking that may not be the right benchmark. Let me just ask a small follow-up question. Would it be legal to use a different set of variables, X variables, for making the prediction on different subgroups? In other words, okay, we're not going to use race or gender and so on, but is it still possible and legal to use a different, you could imagine that by using a different set of X variables, you might actually improve your predictive power, right, for different subgroups. I don't know whether you're allowed to do that. That's one question. And is it the case that you do improve predictive power?
So the answer to your second question is that you're not quite allowed to do that, especially if those variables are very closely related to the race. And this is redlining. This is classic redlining that's out there in the literature. Suppose, for example,
that's what
I go to a very small neighborhood in Brooklyn, and I know that the density of the population is close to 100% African American, then I might be very worried about the fact that that has been used incorrectly. So that, that's clearly off the table. But in practice, it turns out that showing that this is, this kind of treatment, this disparate treatment has occurred is hard. And it turns out that often, in some of the legal work that, we sort of surveyed when we were doing this paper, that people look at outcomes rather than, loan outcomes, rather than looking at inputs into the model. So I think that's, that's a great question, and that's very important. The second thing that I would say in response to your first question is, we're sort of backing into that question in the sense that, there's really this question about whether the machine learning technology is getting you closer to the structural probability of default, or it's getting you to this triangulation-based solution, which is sort of, backing out your excluded characteristics using included characteristics. I think our inference is that essentially more of it is coming from backing out the structural default probabilities for minorities in the data in a more efficient fashion. Now, you might then argue that why is that structural mapping exist? It's because, for example, there are regions of the space. In particular, there's lots of low-income Black borrowers. Now, you might ask the question, why is there low income for Black borrowers in the first place? Turns out that there may be structural inequalities there in the background, right? But then you're still back to the same question, but you just now have a more informed debate. And in some sense, what we would say to you is, don't try to tinker with the mortgage system to try and do these things at the back end. Solve the structural inequalities directly, because machine learning is unwinding any of the tinkering that you're doing with the system. I mean, that would be another way to reinterpret our results.
Okay. Thank you. Very interesting.
Thank you. Just one last question. We are out of time, but I wanted to ask you this question from Daniel Wu. He's asking, would it be possible that, or is it possible that the unfavorable results for African Americans on the intensive margin are driven by the favorable results on the extensive margin?
So it turns out that, so this is a good question, but it turns out that, it's not that easy. And this is essentially what we're trying to do here. We're saying that, it is true that for those that are included, that is to say the extensive margin newly included Black borrowers from the random forest are indeed getting higher average rates, right? So it is true that you are expanding credit to that population, but in a sense you're doing it, by, now of course you're also giving them that credit, okay, in a way that sort of, has higher standard deviation as well. So there is more kind of statistical, cherry picking borrowers that's going on in this approach. So I mean, I think, as to exactly whether that is the case, and that's where all of the effects are coming from, not so clear. Okay.
Thank you so much. Let me thank Tarun for the great paper and presentation, and make sure to connect next week. We're going to have Itai Goldstein, and I wish you a wonderful weekend and see you next week.